Hi, it's John. Thanks for joining us again. I'm here today, very excited to be joined by the co-founder and CEO of Boosted.ai. It's Joshua Pantony.
How are we doing?
Doing great. I was hoping you could start things off. You've got quite an interesting career background and entrepreneurial story to date. Before we get into Boosted, could you tell us a little bit more about what you've been doing in your career?
I got my start about 10 years ago as the co-founder and CTO of a company called Maluuba. Now, Maluuba was basically like a version of Siri. It was a voice-based personal assistant, but we powered devices that were not Apple. So we were in a bunch of different Android devices. We started to get into some TVs. We're just starting to break into cars before we sold about 50 million devices worldwide. Before that company was ultimately bought by Microsoft and turned into a division of Microsoft Research. Now, kind of halfway through that, I got recruited by Bloomberg to really help Bloomberg with some of the earliest machine learning initiatives that they were working on. In my particular team, I was, I think, actually the very first machine learning hire that they made. And when I first joined, the whole thing kind of started as a small little research project. By the time I left, machine learning at Bloomberg powered everything from the primary search engine results. I think it's the second or third most commonly used mnemonic. Any kind of autocomplete is partially powered by machine learning. Market moving news, Twitter sentiment, knowledge graphs. By the time I left, I think there was about 60 people across the company working on these types of problems. And the scope had really, really advanced. And so that was really exciting and interesting for me because I got a chance to sort of build in a small startup, take a bunch of those learnings, and then apply it into a larger organization. Now, kind of 4 years after I joined Bloomberg, Maluuba was acquired by Microsoft, and I was still one of the largest shareholders. And so I ended up in an interesting situation where, for a variety of tax reasons, it was extremely advantageous to come back to Canada. And so I ended up in downtown Toronto with kind of this expensive background in machine learning, a lot of exposure to what was being done in finance, and some liquidity. And kind of taking all these things together, I started thinking about what I wanted to work on next. And I found machine learning for investment management to be really, really fascinating because you've seen this extraordinary explosion of different data sets over the past 5-6 years, right? Whether it's market moving news, satellite imagery, or even more benign things like traffic movement. Looking at being able to look at every single aircraft, where they flown to, the literal exact amount of distance traveled, being able to track things like oil tankers and where they're settling, credit card transactions, just hundreds and hundreds of these data sets. And if you're a traditional fundamental manager managing a multi-billion-dollar book, it can be really difficult to suddenly come in and try to figure out how to actually incorporate these kinds of data sets or these kinds of new machine learning systems into your process. So we built a product where basically an investment manager can come into the system. They can tell the system the set of data that they want the machine to learn from. They can tell the system what it is that they're trying to predict on. The system will learn patterns from the data, make recommendations based on it, and really importantly, it'll communicate back to the manager, this is what's driving that decision. And so it makes it really, really easy to integrate machine learning into every part of the process. As a particular example, maybe you're a portfolio manager of a $1 to $3 billion hedge fund. You've traditionally operated by making predictions about where you think revenue is going to go. And all of a sudden, someone comes along and tells you they think there's a lot of alpha sitting in credit card information. You can come to our system. You can give the system credit card data. You can give the system's earnings reports. You can give the system, maybe market moving news, maybe some set of balance sheet information, whatever it is. You completely customize the set of data you think the system should be looking at. And then you might tell the system, find the companies that are most likely to beat earnings, or find the companies that are most likely to have alpha, or find the companies that are most likely to see an increase in volatility over the next 3 months. The system will go out, it'll learn patterns, and it'll say, okay, here are the top 10 companies most likely to beat earnings. Here's the top bottom companies most likely to lose versus their earnings predictions, and here's why. Here's the very specific pattern that was picked up on from the credit card data versus what the analysts are saying versus the balance sheet. And so it becomes this very hyper-tailored way of incorporating the data and the ML and then kind of building these kind of systems into your investment management process. So that was kind of my background and the impetus of the company. And launched that in 2019, and then have just kind of continued to rocket from that. Last year was a particularly interesting year. A lot of traditional quantitative systems really broke down with COVID and then the vaccine, and even this year with some of the stuff happening with Gamestop. And I think what's been really interesting and remarkable about our system, it's using very non-standard data, and it's using very non-standard ways of sort of analyzing the world. And it seems like it's been a lot more successful modeling these kinds of black swan, high risk events.
Interesting to hear that. I think that's something a lot of people who might not be as familiar with AI or machine learning would imagine would be a risk if it's backward looking and it didn't foresee something like COVID changing markets dramatically. But it's good to hear that that's something you can work on. You've said a lot about the market opportunity, your background, and what Boosted actually is. Is there anything else you can tell us about what differentiates you really from some of the competitors that might be out there doing similar things in asset management and financial services?
Yeah, so the product's kind of interesting because it covers so many different things. There's sort of a stock picking aspect where you can come in and use it to help you find different longs or shorts. We've got a whole element around how you can do risk mitigation and portfolio construction. There's the way that we approach back tests and looking for problems in data. And so there's kind of different competitors at a few of these strengths, but I think what makes our product quite unique is that we've put all these different verticals with really sort of best-in-class approaches, and we've integrated into one spot. So to talk about one particular example, in the risk mitigation side, a lot of people will traditionally look at, say, Axioma or Barra and use that to sort of evaluate their risk books. And if you were doing that last year, you probably had a particularly poor March. If we look at the traditional risk factors, you're looking at things like momentum or volatility. Usually momentum does very poorly during a downturn. Last year, momentum was by far the safest thing that you could be holding throughout most of the year. You might traditionally look at the covariances between different stocks. Well, last year, SPG, which owns shopping malls, was heavily correlated with retirement homeowners and was heavily correlated with fitness equipment. I could be wrong, but I don't think there's ever been the case ever where fitness equipment, retirement homes, shopping malls, and hotels were all heavily correlated and formed the same kind of risk factor. So if you were using a traditional sort of covariance-based approach, you had a fairly poor time. What was interesting about our system is we can come in and we can kind of track using some of the data sets, say the semantic connection. So we know that SPG is related to shopping malls. We know that shopping malls are related to social distancing, and we know that social distancing is then related back to COVID. We know that NCLH is related to cruise lines. Cruise lines are related to historical things like Zika, and in general also affected by social distancing. So again, that can kind of come back and relate into COVID. So you've got to think, fitness equipment is related to social distancing. And so because we can kind of build this mosaic of connected ideas, it becomes very easy to come in and model COVID as a risk factor, or model the effect of a vaccine as a risk factor. And all kinds of other things, right? You could come in, you could ask about gaming as a risk factor, or something you want overexposure to, underexposure to. And of course, you can do traditional things like oil and momentum and volatility. But I think what's really interesting about our system is because we can look at the world from a different way, we can start to really add uncorrelated sources of value, and we can start to model problems that a lot of traditional systems have broken down on. And then, kind of finally, this all ties together in a really beautiful way because the system's actually explaining its hypothesis. It can explain to the user, this is why we think this is a particularly risky stock, or this is why we think this is a particularly good buy. And the user can then incorporate their own human knowledge, say, okay, I understand why you think the stock's going to go up. Maybe it's got really good momentum. Maybe the balance sheet looks particularly good. Maybe you like the credit card transactions coming in. But I also know intuitively that there's some competitors entering the market that the machine doesn't know about. and it's clearly not incorporating that in the decision process. So maybe I want to disagree with the machine in one of these cases. So, kind of just to fully summarize it, it's the ability of the system to look at non-traditional systems in a non-traditional way, and then also explain its logic in a really deep way that we think brings a huge amount of value to our clients versus other systems.
Fascinating stuff, Josh. I wondered, as you were finishing up, I think your third point there, you mentioned an important factor, which is the machine-human interaction here. A lot of people have a vision of hedge fund run on its own by an AI, but you're talking obviously about this being a tool. Can you say a few more words about the balancing act between the asset manager and the tools that they're using?
Yeah, so I think the future, at least for the next 10 or 20 years, is ultimately going to be a combination of human and machine interaction. AlphaGo very famously beat the best human player at the hardest possible human game. And it's been consistently beating the top players. But what's really interesting is that with most of these really sophisticated AI systems, if you combine AlphaGo with a human player, it can almost universally beat just AlphaGo on its own. And in kind of a similar vein, we're of the opinion that the future of this industry is ultimately going to be human creativity paired with the machine's ability to think about things in a much broader scale and in a much more detailed scale than any human can do. And so kind of our entire system is built around that interaction. And human comes in with a hypothesis, things that they want to build, and then we make it easy to run those experiments and kind of incorporate it in. And it's kind of the way that works is we really think of the problem as having two distinct problems. One is related to how do I decide which set of stocks do I want to potentially be buying or selling? So I'm going to come in and I'm going to create some form of alpha signal, right? Whether it's trying to predict revenue or trying to predict alpha directly, or if it's trying to predict, volatility to find spreads across implied vol, or whatever it is, you're going to try to find some sort of signal that you're trying to make a prediction on. And you're going to have some set of inputs that are going to drive that prediction. Again, whether it's credit card data or market moving news data or traditional things like balance sheet and momentum. And then once you have that, you can first evaluate the machine on its ability to sort of separate the winners from the losers. So how often when it thinks something is a Q1 buy, does it actually beat the benchmark? And how often when something it thinks is in the bottom quantile, does it actually lose to the benchmark? And so that gives you one sense of that part of the problem. And then the second part of the problem is how do I actually take this and build it into a portfolio? So, do I want to go net neutral? Do I want to go long only, long short? Do I want to trade this every day, every week? Do I want turnover constraints, right? We have some clients that turnover as little as 40% a year. Generally speaking, you're talking, large long only shops. And then we have some clients that are turning over as much as 5,000% a year, where they're trading every single day. So what are my trading constraints? How much cost do I think I'm going to be taking making these trades? And then finally, what are my risk exposures that I'm comfortable with? Do I want to completely net neutral? Do I want to minimize my volatility? Do I just want to maximize alpha? Do I want to maximize alpha with constraints to volatility exposure, momentum exposure, or non-traditional risk factors like COVID or vaccine risk or retail interest or whatever it is, and then we kind of combine these two systems to produce the final portfolio that you can then incorporate. So we have some users that come in and use the system as kind of an analyst, another sort of angel on their shoulder, giving them good advice on potential buys and shorts. We have some that use it primarily to risk mitigate things out that they're not able to sort of attach risk to on their own. And then we have quite a few clients that are coming into our system and building portfolios end to end, and then using it to directly run on that. So we have some clients that are either launching mutual funds on the back of this, or hedge funds that are running direct capital on it, or incorporating it a whole bunch of different ways in the investment process.
It sounds like a powerful tool, and you're already discovering the various ways it can be applied. You mentioned a few minutes ago the explosive growth you've had since 2019, and that's fitting for the name of the company. I was hoping you could just take a couple minutes and give us highlights of some of the milestones, and in particular talk a little bit about the funding story and how you've been able to build the company along the way.
Yeah, so we've raised 11 or 12, I guess, depending on how you talk about it, million USD to date. And the funding was by far one of the most interesting experiences of my life. So we initially, I think between Nick and I, and maybe one or two other people, raised just basically a founder round of about $1 million. And we kind of launched the company off that. And then I think the end of 2018, we raised another $2 million. And really, we raised that from a number of different angels. There was a few different local VCs that chipped in. We also had a whole bunch of different portfolio managers who chipped in. Most of them ex-portfolio managers. Word kind of got out in some members of the Tiger Network, and so a few ex-Tiger portfolio managers chipped in some capital. Ended up raising up to a total of $3 million, which was enough to finish the product, launch it out in 2019. We saw explosive growth from May 2019 up until about Feb. And then we started raising our Series A kind of end of 2019, beginning of 2020. Now, February was a particularly interesting month for me because we received term sheets. And then, of course, the world went where the world went. And so we ended up closing the round, I think, in March, April, in that time range, right in the middle of the COVID crisis. I got to give a lot of credit to our investors. Every single one ended up pulling through. We still managed to get the round done, but it was kind of an extraordinary time to be trying to raise capital. But we managed to finish it. And then kind of going into the summer, we started to see a truly massive pickup in the business, and that's been largely continuing to today. So we raised $8 million for the Series A USD.
Such is fundraising in Series A for deep tech, so I'm not entirely surprised, but I know that's an endeavor, and congratulations for making it through that new orbit. I was wondering, you said a little bit about where things are today, but could you say a bit more about what the focus is currently, whether it's on business development, technology, or continued fundraising? And really, what's the vision and the plans for the next couple of years with Boosted and yourself?
So, kind of the big question at the beginning of last year was around, can we build and automate sales? At the time, it was largely the founders that are going out and selling it. How big is the TAM of this truly? At the time, I think 80% of our clients were Canadian. We just started to get into the US. Generally speaking, most of our clients were larger. I think our earliest clients were primarily banks. And so, one question was, can we scale sales? Another question was around, what truly is the TAM of this space? There was a concern in the early days that maybe this ended up being more of a niche product and just focused on a few local banks. What's been really interesting over the past year is just the growth we've seen across different types of firms. So our smallest firm today is a $30 million family office, and our biggest customer today is a $400 billion long-only shop. So we've got huge, distribution across different segments. We have clients based in the US, clients based in the UK, clients in mainland Europe, and we've just started launching into China. We've got 2 clients, one in Singapore, one in mainland China, and it looks like we're going to be doing another 4 over the next week or 2. So our growth has started to become extremely international. Our growth across different segments has started to really pick up. And so now we're kind of sitting at a spot where the TAM of this, the total addressable market, is truly massive. We've seen huge use from the tool from a massive variety of different firms. And I should also talk about the firms a little bit. We've got clients that are, $100 million hedge funds that are long, short, completely net neutral, high turnover trade, where they find value in this. And then we've got clients that are long-only shops that trade once a quarter, are trading billions of dollars, and are maybe doing a 30 to 40% turnover a year. And they've been able to get a lot of use out of the product. So both a huge variety in the clients, but also a huge variety in the way that the clients are using it, if that makes sense. So that's kind of addressed. Okay, clearly this is a massive market. The second side of the question, could we scale up sales? And the answer there has been yes. Sales team is about 4 or 5 times bigger than it was at the beginning of last year, and will probably be another 3 or 4 times bigger as this year grows. And we've been doing a really good job at bringing in top salespeople who are able to add value and sort of keep up with the pipeline of incoming clients. The biggest question for me today, and I think the biggest question that stands between the company where it is today and the company becoming a unicorn, is can we scale fast enough? Can we do 4 or 5x in revenue? And can we do that every year for a few years in a row? I think the answer to that question is probably yes, but we don't quite have the data around it yet. And, last year was a particularly interesting year. It ended up being a pretty good year for us, but I don't think it's the best data point in terms of what the company's going to look like long term. And so the thing that keeps me up at night, the thing I am most focused on right now, is how do we scale? How do we get as much into the pipeline as possible? Whether that's marketing, whether that's putting on events, conversations like this. We're very hyper focused now on trying to fill up and get as much use of the product to as many people as possible. In terms of where I see the company going over the next few years, when I sold Maluuba, it was about a 100, 200 in that range sale. And it was a very interesting thing to experience, in one's 20s. But I think it also sort of set the benchmark in terms of success and what I really wanted to build going forward. And so I was thinking about new opportunities. I really wanted an opportunity where I thought if it was successful, it would be a multi-billion-dollar company. And where I'm sitting today, I think this particular company, in a world where it's truly successful, there's nothing stopping it from being a very strong, independently traded company. And so that's kind of my vision. I want to build this into a very large, multi-billion-dollar organization. I want to base it primarily out of Toronto, partially out of New York. And I want to get to the point where we are penetrating a huge part of the market internationally and not just locally.
Great to hear a strong Toronto entrepreneur talking about such ambitious plans. I hope I can convince you to have a European hub here in Switzerland. It's a great place for asset management and family offices, and skiing if you're into that. But Joshua, knowing you're a data guy, I wanted to make sure I covered two more tangible questions before we got into some of the more interesting stuff that's going on in financial services these days. I wanted to ask, first of all, can you just say a few words about what's the actual business model? How do clients engage with Boosted.ai, and how do you monetize that in the long term? And then I'll follow up with the second one because that's a bit of a mouthful, I think.
So I can't give you the exact numbers over the line, but I can say we charge per seat. And per usage to some degree. So generally speaking, when we meet with a client, there will be a 3 to 4 month period where it's heavily discounted, just a chance for them to come in, use the tool, and make sure it actually adds the value that we say it adds. And then usually that turns into a 1-year committal, and we're usually charging based on the number of logins that are using it, and then maybe some constraints around how it's actually used. But it's a seat model, fundamentally. I guess the other thing I should mention is because it's value-add data, in most jurisdictions, it is soft dollar eligible.
Great. And for those who aren't familiar with soft dollars, do you want to just quickly explain what that is so it's clear?
Yeah. So soft dollars basically means it can be charged out of the fund. So instead of charging out of the revenue, if you're like a $100 million fund, as an example, and you're paying for the product, and let's say you're charging 2 and 20, you're really only paying for 2 and 20 on the base cost of our platform, as opposed to paying for the entire platform, because you're basically paying it out of the fund directly.
Thanks for clarifying that part. Something else that I think is important to just touch on. I mean, we're blessed to be in cities like Toronto and Zurich that have huge talent pools when it comes to machine learning and artificial intelligence. But it's a bit of an arms race right now. And I was curious to know, how do you approach the war for talent in your industry?
It's insane. Without going into numbers, the amount that we hire a starting dev at right now is probably 3 to 4 times higher than when I graduated university, just over a decade ago, I guess. So I think there's a few things. Right off the bat, I started Maluuba, and then I was heavily involved in building some of the machine learning teams at Bloomberg. So, and then of course Maluuba went off and turned into a division of Microsoft. So just personally, I guess out of sheer luck, I had an extensive network that I could build off of. And so I think the first, 6, 8 hires that we made into the company on the engineering side were all people that had worked with me for years. So I had really strong lieutenants I could put in day one. I had really strong developers that I could put in. And so that's kind of an unfair advantage that I, second-time entrepreneurs have that people first starting out probably don't. I think the second thing, though, is kind of long-term. There are so many things that you can be working on, so many different job offers. You can compete on salary, but my experience is ultimately that's only going to get you so far. You need to be solving interesting problems. You need to be convincing people that you're solving interesting problems. And you need to really, when we're meeting with candidates, when we're interviewing them, when we're bringing them in, we really sell them heavily on, you're going to be doing work here that you really can't do anywhere else. You're going to be working with talent here that you really can't be working with anywhere else. And then I think that sort of initial seed of talent that I brought in put us in a really good spot for continuing to engender that. So when we do bring people in, there really are truly engineers here with skill sets you probably won't find very many other places. And we are working on truly world-changing problems. And we're continuing to engender that environment. I guess the other kind of comment I'll make just around the culture side, it's also really important that you're developing culture, and it's been very tricky for a lot of companies to do that in the current environment. For us, we wanted to try to maintain a startup vibe despite the fact that everyone's working remotely. And so we've done things like buy all of our employees VR headsets, and then we throw on these big virtual reality events. We'll try to set up different types of interactions outside of work, and we'll try to make sure that we're constantly cross-pollinating across different teams. So my machine learning team is interacting with guys on the front end, or some of the back end engineers, or interact with people on the sales side, or just different groups of people that wouldn't normally interact. We find just the uniqueness of the perspectives that get brought in both can help on the product side, but also can kind of keep the interest in the company and what we're ultimately trying to do, and keep the vision somewhat cohesive.
It sounds like a great place to work, and congratulations on putting together that sort of an atmosphere. There's a couple of big topics that are looking at, let's say, manipulation in the markets, and actually, I guess a better way to put it is democratizing financial markets in the digital economy. On the one side, we have cryptocurrencies and distributed ledgers, and then we have this example in Gamestop, which brings in hedge funds and data sources and things about market access. I was wondering if you have some thoughts on those two big topics.
Yeah, I mean, I'll say on the GameStop without throwing anyone under the bus. I think risk mitigation and risk management of the short book is very important, and I think it's often overlooked. And I'll say that is something that we've seen heavy interest in the wake of January. I'd say maybe a third of the meetings we get, how can we use your system to prevent our short book from blowing up? I guess I'll also mention anyone who was using our system to help manage their short book did not blow up in January, and that is something that we're in a good position to help with. Beyond that, I guess I think it's interesting that a bunch of retail buyers were in some ways able to engineer a short squeeze. I also think it was kind of inevitable. We've seen from the data that we've been looking at a massive pickup in retail trade since March. In fact, one of the other co-founders here, Nick Abe, wrote an article back in August talking about how retail investors were going to start to get to the point where they could move the market and affect it. And I think it was just a matter of time before that retail activity interacted with some set of hedge funds that maybe could have managed their short book a little bit better. And so I think, if anything, it's interesting to me that the story got picked up by the media in the way that it did. Because to me, these are two inevitable trends that we're going to hit eventually, and we'll probably continue for a little while. On the cryptocurrency side, I don't know if I have that much useful to say. I think it's interesting. I think it's certainly picking up more legitimacy than I expected. The recent $1.5 billion buy by Tesla shows that there is starting to become larger interest in it. I don't know how much it's going to affect most of our clients, though. And I'll say in general, people are not really using our system as of today to manage cryptocurrencies. The vast majority of it is managing things related to equities and maybe a little bit of derivatives, maybe a little bit of fixed income. But we have yet to have a client who's come in and asked us to help them model Bitcoin as an example. So there's not too much I can really comment on that.
Fair enough. I think what you've said about Gamestop is very poignant. There's a lot of debate around that, and I think you went right to the core of it. Is there's something that was exploited that could be better managed, and this is a good opportunity to look at solutions for it. And kudos to you and your clients who were able to avoid that pitfall. Cryptocurrencies, I was hoping you would have some forecasts for us, but I guess I'll leave that behind. For those who are interested in using your tools and getting better forecasts themselves, can you say maybe a minute about how they can engage and demo your product and engage with your team?
So if you just go to Boosted.ai, there's a sign up form on there. We're happy to set up a demo or show the main product. I guess you could also reach out to me at jp@boosted.ai if you had specific questions. Always happy to take inquiries. Beyond that, the way the process usually works, you come in. We'll usually try to do a quick 10, 15-minute intro call, kind of understand a little bit more about the business that we're interacting with, the mandate, what it is the client's trying to do, and then we'll set up kind of a tailored demo. So, as an example, if you're managing a $100-200 million book, you're a long-only shop or maybe a family office, you'll probably have some turnover constraints. You'll maybe have a mandate where you're trading heavily in Europe or where you trade in North America. Maybe you want to go long-short. We'll then set up a demo, and when we do the demo, we'll actually have built an example model in our product heavily tailored to your particular mandate and the type of thing that you do. So it's a really cool process. And we find there's a fairly significant amount of interest once we actually get to the process of doing a demo and showing something a little more tailored.
Very cool. We covered a lot of ground here today, Joshua, so I think it's probably a good time to start wrapping things up. Was there anything that you didn't get a chance to mention that you think is important for the audience to keep in mind?
The only point I just want to sort of rehash, if people come away with only one thing from this, it's that we've built a system that makes it really easy to incorporate extremely top-of-the-line advanced machine learning with non-traditional data sets, and we do it in a way that's very easy for a human to understand. It's designed to work with your investment process and integrate with something that you're probably already doing today. And I'll also kind of mention on top of that, 80% of our clients today come from a fundamental background. You've got about 20 that are on the quantitative sides, and some of them are very, very sophisticated quants, but the vast majority of clients using it today are from a fundamental background. They don't have machine learning experience. They don't have programming experience. Just a very easy point-and-click interface that's designed to explain the set of actions it's taking and integrate into the process.
A nice, friendly Canadian pitch for something that a lot of people are a bit intimidated by. So we will be sharing links to get in contact with Boosted.ai, Josh, and as well your contact info, which you were kind enough to share. Thanks again for taking the time out. We know it's cold and you've got to keep moving over there in Mississauga, but all the best from Zurich. We look forward to catching up soon.
And great meeting you.
Likewise. Cheers.